Good evening and welcome to tonight's webinar where we look at member-only content for ASX investment opportunities in review for the 23rd of August. The advice provided this evening is general advice only. Investor Signals provides a broking account service which gives access to our algorithm models. The most popular model portfolio, which we'll cover tonight, is the ASX Top 50. It's common that clients will run access to either our US models or a combination of US and high conviction models. And within the brokerage account service, we can operate an independent portfolio where if there's specific ideas that we jointly agree on that we want to develop an overweight position in, we can do that either as part of the overall portfolio through the independent section, and we can also utilize derivatives to enhance portfolio returns through covered calls, or use long call options or put options as a way of getting directional exposure to the market. If you'd like to talk to me about the brokerage account service, please contact me on 1300 614 002. The products that Investor Signals provides covers the research, which is a subscription to our member area, which is $1,320 for the year. That'll be the technology that I'm using tonight. The brokerage account, as we just discussed a moment ago, and our managed funds. Again, if you'd like to know more about those, please give me a call in the office. This evening, what I'll do is we'll start with a refresh of what's been posted on the blog in the last 7 days, and then we'll take a closer look at the ASX Top 50 model with a specific focus on our asset allocations as to which stocks we're overweight or underweight across that top 50 model. Looking at the commentary on the blog, so this is inside the member area. If you're joining us for the first time, part of your 30-day free trial, under the news tab loads the research blog. The home button will always load up the home page. And then obviously you can select specific categories there to look at. You can access your categories down the side, your recent posts or particular symbols. But we make sure that home button's displayed green rather than grey. Means we're starting on the home page. Each afternoon you get the signals. So looking through the signals, what's interesting, and I'll maybe touch on this evening, is MIN's now being triggered as a long signal, and we're seeing that across the resources, so across Fortescue, Rio, BHP's been under buy signals for a while, OZR, which is the ETF, so there's a couple there that we'll view tonight as I go through those top 50. The recent changes to the model portfolio, each morning, if across the various models that we run, we post on the blog for you a summary of any recent changes. If you want to customize your model portfolios, just a reminder, click on model portfolio and just make sure that that envelope beside the list is green rather than grey, and then you'll actually get the separate email notice specific to whichever models you have that green envelope turned on for. So in the case of the US, we've had American Express switch to algorithm buy signals, which will see that added into the US model portfolios. Treasury Wines, this is a stock that we focused on some months back when it shifted from algorithm sell signals, which is the red marker up the top, into an algorithm buy signal. The algorithm engine's picking up that the stock was making a higher high and higher low, forecasting that the downtrend in Treasury had ended and we're into what looks like the beginning of a new uptrend. That was when Treasury was trading at around $10. It's now pushing up to $13 there, and you'll find that in the ASX 100 model portfolio. Link is another example where we've seen this in a downtrend for a number of years, and the algorithm engine suggesting that we're in the early stage of an uptrend beginning. And when I look across the fundamental analysis for Link, it seems plausible that the company will deliver around 5 to 8% earnings growth, supported by an attractive dividend yield. So what we're looking for is the stock to find support, and this was going back a few weeks when I originally posted this, at around $4.80. Since then, as these posts show, that the the stock started to rally, pushing up to around 5.30 as a high. It's pulled back a little bit off that at the moment, so you'll find Link in the model portfolios as well. Woodside, I've highlighted on the blog that the suggestion here is to accumulate Woodside, and my thinking there really is, beside the fact that it's under algorithm buy signal and you'll find it in the models, looking at the merger with BHP, in simple terms, there's some level of comfort that BHP is not doing this transaction on the basis of taking cash off the table. BHP it's a merger of the energy assets with BHP, which leaves BHP as an equity holder in the new combined Woodside BHP energy assets. Energy prices have been a little volatile over the last 10 days. We've seen them pull back from almost mid-70s to mid-60s, but there is some buying interest in the energy complex, and we've seen oil prices push up a couple of percent today. But generally speaking, accumulating Woodside around this $19-20 range and taking a longer term view on it, collecting the dividend, looks attractive to us. Cleanaway, happy with that earnings result. It came in line with market expectations. The stock has since rallied, and this post here was just highlighting Cleanaway was under buy conditions. We've since seen it rally off that support. The concern for Cleanaway is obviously the impact from the shutdowns in New South Wales in particular, but also in Victoria, having an impact on earnings. The long-term thematic for Cleanaway still remains attractive, and it is a business that should, in normal trading circumstances, be able to grow earnings at around that 5% per annum, delivering just under roughly a 2% dividend yield. But we continue to like Cleanaway. Looking at the posts here, so just a reminder, we've had the signal in Fortescue within this within the iron ore complex. We've also had Rio. It's corrected from 140 down to 105, so we've started accumulating a position in Rio, but certainly not overweight yet. We've already covered Link. Collins Food, so this was a buy signal. You can see there the build-up of the green algorithm signals. The post on the blog was just to draw your attention to this $10.50 entry level. Our target here was at least up to $12, and that's more of a reference for shorter-term traders than it is investors. From an investing standpoint, the stock would stay in our model as long as it remains under algorithm buy signal there in the green. But from a pure trading standpoint, looking for the momentum where the stock price crosses above this average and it trades up towards that $12. Collins has now done that. We'll just move back to the older articles. I'm only going to cover a week of recent posts here. Car sales, the fundamentals, the earnings results certainly met market expectations, with EBITDA increasing 20%. So we keep an eye on this in the next 3 to 4 months. May take a little bit longer, but I'd expect to see this pull back and generate an algorithm buy signal, and it may be one that you want to have a look at adding to your portfolio when that occurs. The buy now, pay later. I see today that Sizzle has been supported by Goldman Sachs with a US listing, which is a vote of confidence, but this particular post here was just highlighting that we're starting to see a pickup in the bad debts in some of these buy now, pay later. Zip has been the one that we've been following. We haven't built a position in it yet, but it is the thinking with Zip is obviously Afterpay's had its takeover or merger with Square in the US, and Zip may be subject to some level of corporate action. But just to put that in context, there are rising risks in the buy now, pay later area with the bad debts. Woodside already covered. Recent signals. ASX we hold, but getting close to a level we're happy to take profit on that at the moment. Lumber prices, as I mentioned in last week's recording, I'd put a graph up. So across the commodity spectrum in general, we've seen a lot of the aggressive buying exit the market, and we've seen a correction in commodities from iron ore to energy to lumber to copper, nickel, etc. So in the case of lumber, this is a long-term graph going back to 1984, just to put in context of the extent of that rally that we've had. And then a shorter term, just over the last 12 months, we can see the correction here from May that's seen lumber prices almost halve that rally that we've had over the last 12 or 18 months. So the correction there. Link I've already covered. Woodside. Cure ETF, if you've been following the recordings or the blog, this provides access to US biotech. We started to see some buying in Cure today. So you're able to click on these hyperlink codes and that'll take you into the chart. So loads a new browser. Try that this way. So we can see a little bit of buying interest in Cure today off that $57 level there, but generally the correction that we've had from 85 down to sort of 56, 58, I think that's an attractive area to start accumulating that. So that was the Cure ETF. We had an algorithm buy signal in Bendigo, but as I've mentioned in prior weeks, our preference is really either the MVB, which is an ETF on the banks via the ASX, or the BNKS, which is the global banks. Also the IKO, which is the iShares South Korea ETF. If you're looking for global exposure, that's a consideration. And then we're back to last week's webinar. So that, it's worth just revisiting this post, which was, I think, put on Tuesday last week, which is a US consumer sentiment. So it's just worth highlighting. I did speak to this, but didn't have the image available last week in the webinar. But what we've seen is this consumer sentiment fall down to 10, 11-year lows. Now, that could obviously be partly explained by the increase in Delta variant, but it's also a combination of the buoyant reopening trade and maybe a slight wearing off of the US stimulus that started. So that we need to keep an eye on this, because we've also seen weak manufacturing data globally. Services remain strong, but we just continue to sort of watch some of these data points as to how that impacts the broader stock selection at the moment. And with that, let's click on watch list. We're going to move through these tonight by way of ASX top 50. We're going to look at the stocks that are under algorithm buy conditions. We'll get part of the way through the list and then they'll shift to stocks under sell. All the stocks under algorithm buy, you'll find those in the model portfolio under ASX top 50. Again, if you're joining us for the first time, a couple of ways to look at the performance of this top 50 model. You can do that by percentage, so by percentage gain, or the stocks that are underperforming, which is only a couple of them, or you may also like to arrange it by days held, which is my preference. I like to look at it from the point of view of which stock was added most recently to the model, which is days held, the number of days held, and just a reminder that it totals up the dividends and adds that to the performance gain of the stock. So this evening, starting with the top 50 stocks, and again, these are all stocks that are in the top 50 model. Part of this evening will be, I'll talk a little bit about our asset allocation and which stocks we've developed an overweight position to in our client broking accounts. So Aristocrat's an equal weight position for us. It's shifted from algorithm sell signals there to an algorithm buy at around that $30 level. Continues to make higher highs, higher lows. In the prior week's recording, I drew your attention to the prospect of Aristocrat being a trading opportunity as well at around this $40 level, expecting for it to find support. It's now rallied about 10% from there. So if you did set that up as a short-term trade, you could think about taking profit in it. Again, from an investor portfolio standpoint, we stick with this stock as long as it remains under algorithm buy conditions, and it could be months or years before the stock rolls over and makes a lower low, lower high, and we'll see that removed from the model. But for now, it's in there, and it's one of the better performing stocks. ANZ, under algorithm buy conditions, support there at around that $26 level. The general wrap of the banks following the earnings results is revenue growth was low levels, 1 or 2%. They are seeing the benefit of cutting costs coming down on average 1 or 2%, but we are in an environment where they're going to find it tough to grow revenue. So at best, we think the banks mostly move sideways, and it's more about an income trade for portfolios. Afterpay switched to algorithm buy conditions some time back and is performing very well, one of the better performing stocks in the model. BHP, under algorithm buy signals, the history here is it switched from sell to buy there at around $45. We've taken profit from this in portfolios, and we've reallocated that money into Rio, and our timing was very good on that, in that we'd got out of BHP at around this $53 level, and we've started adding a small position of Rio, which will begin building with, and I'll get to that shortly, and we'll begin building the position size of Rio up. But BHP is something you can start to have a think about on the buy side if you don't already hold it. CBA, under algorithm buy conditions, the switch was from here back in 2020 into algorithm buy signals earlier this year at around $80, now pushing up to $100. As you know from prior commentary, CBA is expensive on a relative basis to all global banks, and that may be something that you weigh up when you're thinking about do you want to use that BNKS, which is the global banks ETF, as a way of capturing growth in the broader global banking area. But we're certainly not running an overweight exposure to banks at this point in time, with our real preference being Macquarie. Cochlear, under algorithm buy signals, delivered a good earnings result, came in line with expectations. Underlying growth was around 20%. Strong revenue growth and strong profit growth there. Computershare, under algorithm buy conditions, so the switch back in 2020 into buy conditions in late 2020 or September last year, and the stocks continued to make higher highs and higher lows. The most recent buy signal here was at around $15. Computershare and Link we continue to like. We don't think the earnings growth is particularly strong, but they are in an area of the market where those income and growth numbers are reasonably stable. Fortescue switched from algorithm sell signals into algorithm buy back in 2019. We've had subsequent algorithm buy signals here at 15, and then again we're now seeing the correction from $26 down to $20 bring up these buy signals. This applies for whether it be BHP, Rio or Fortescue. The backdrop's been that iron ore's corrected from 220 down to a low last week of 130. It's bounced off 130 up to 140 a tonne at the moment. Bears have, like the bearish case for iron ore over the next 18 months to 2 years has it back down at around $55-$60. But that's a very bearish view on it. The base case by most analysts is that iron ore trades somewhere around the 120 to maybe 160 level. So a lot of the analysts have models somewhere within their valuation models. They're using spot prices around that level, around that 120 to 160 level. So if we take the midpoint, they're at around 140. So really, if iron ore was to consistently trade below that 140 level, these iron ore companies would be subject to valuation downgrades. So that's just something for us to keep an eye on. For that reason, we haven't built an overweight position in these. Our preference dominance at the moment is Fortescue and Rio, but as BHP's corrected now as well, we'll start to have a look at that and reallocate funds into BHP as well. If you're not holding exposure to these big iron ore stocks and you're looking for how you manage the entry level, so from an investor's standpoint, it's not uncommon to average into a position. So I've created a bandwidth there where you can think about half a position size where it is at the moment, and maybe half if we were to see it test lower levels, if we were to see a risk-off period of develop in US equities, which continued to have downside pressure on commodities. But equally, we could be in the early stages of where buying support starting to build. If you want to be patient, you could wait for the price action to cross above that moving average before starting to add to that position. Traders may take that approach, whereas an investor may be more comfortable with just managing the position size and adding to it at lower levels. But we're comfortable holding some exposure to these iron ore stocks, even though iron ore's had that correction from 220 down to 140. Goodman Group remains our preferred property play with SLF, which is the property ETF, but Goodman Group delivered in line with expectations, 15% earnings growth. It now trades on about a 1.5% dividend yield, so it is extremely expensive. We don't think there's much upside in the short term for it, but likewise there's not a lot of downside given the stability of that earnings growth, and we're likely to see Goodman deliver between 10 to 15% earnings growth for the next 2 to 3 years. So unless interest rates really spiked, Goodman's likely to stay at elevated valuations. But if you don't own it, just be patient. On any pullback, you'll see a new algorithm buy signal, and you can think about adding that into your portfolio. GPT, broadly the commentary here, again, if you're joining us for the first time, has been that rather than holding too many individual REITs, we've been holding Goodman Group and Goodman Group and SLF as our preferred exposure. But GPT does sit in the top 50 model, but we've got a relatively low exposure to it relative. So to give you an idea, something that's at the top of the list as far as percentage exposure is Woolworths and Wesfarmers. They're by a wide margin our two overweight positions. Our overweight technology stock is 0. Our only gold stock in there is Northern Star. Goodman Group sits as an overweight Goodman Group sits as an equal weight position, and as does Macquarie, but Macquarie relative to say Westpac, Macquarie sits at a much higher weighting. So GPT under buy conditions, Lendlease under buy conditions. Lendlease is a long-term recovery play. The company's forecasting towards the end of 22 or 23, they expect to see an improvement in their trading conditions. So this is where you start to have a think about how much is your allocation to, say, Woolworths, Wesfarmers, Goodman Group. There probably should be room in your portfolio to start to add a small amount of Lendlease, and we start thinking about gradually seeing that percentage allocation shift up as we see subsequent buy conditions over the next 6 to 12 months. We'd look to start building that exposure in Lendlease. As probably 3 to 5 years from now, we may look back and Lendlease as one of the better performing stocks in the market. Mirvac Group under buy conditions performing well. Macquarie, as I mentioned, we have a higher weighting to that than Westpac and ANZ. The case of Macquarie, we're expecting them to deliver between 5 to 10% earnings growth. Is under buy conditions there. Northern Star preferred gold exposure. If you don't own Northern Star, or if you don't have gold exposure in your portfolio, I think that's a consideration. Rio, so similar to pattern here to what we looked at with Fortescue, has shifted from sell conditions into buy conditions, so we've started building a position in Rio. but certainly have the firepower there to continue to add to it if we see it at lower levels and get an average sort of somewhere between that range indicated on the chart. South 32 under buy conditions, delivered in line with expectations. Centre Group, not sure Centre Group's actually delivered their earnings result yet. They actually report tomorrow. So I'll update you on the blog following that result. Stockland's under buy conditions, delivered in line with expectations. The outlook maybe disappointed the market a little, but residential development sales continue to remain strong. Santos, if you don't hold Santos, our preference is Woodside, but Santos merging with Oil Search, we think that's attractive. It is under buy conditions. Sydney Airports is in the model portfolio. Treasury Wines has performed well. We covered that under the blog. Westpac under algorithm buy conditions, so we hold that, but preference Macquarie still over Westpac. Wesfarmers is under buy conditions, switched from sell to buy in September last year. It's, along with Woolworths, is the largest weighted position in our portfolio, but we have started trimming that. So by a much more significant margin, it was the highest weighted position in our portfolio, but we've trimmed about 30-40% off that. Likewise with Woolworths, which cuts their exposure, cuts the size of the position down, but still has them as our largest allocation out of any stock within our top 50 model. So Wesfarmers performing well. Woolworths, both Woolworths and Wesfarmers we think are getting expensive, but the downside risks are relatively low. Woodside Petroleum, think about adding that if you don't hold it. Xero is our most overweight technology play in the top 50 model, and that's performing well. Think about that on the next buy conditions. A2 Milk under sell conditions. We continue to review the fundamentals there. AGL, so now what you're seeing is stocks that are under sell conditions and they're making lower lows and lower highs, and the reference to this is that the most recent signal is a red marker rather than the green box, so you won't find these names in the top 50 model, and that's because in some cases they may have broken out of their downtrend and they're in the early stages of transitioning to a buy signal, but for the most part these stocks will have lower lows, lower highs, undersell signals. Ampol undersell. Amcor was one of the few counter trend trades where it is undersell signals, but I've been highlighting on the blog that we think the earnings result will be good there, and over the next 6 months I'd expect to see Amcor to retrace and switch back to buy conditions, at which time you want to be ready to add it into your portfolio. Likewise with APA Group, when that switches you want to add that in. ASX probably won't see that switch to buy conditions for a little while, I don't think. Horizon under sell conditions at the moment, it's broken out into a new high. We'll watch over the next few weeks if we see that shift to buy conditions. Brambles on the next pullback, I expect to see that shift to buy conditions. Coles, we may see that shift, but at the moment the preference is still Woolworths over Coles. CSL, we watch that into the back half of this year for a retracement lower and a switch back to buy conditions. Dexus under sell conditions. Insurance Australia Group, the insurance sector surprised on the upside. Strong results out of QBE, Suncorp. Insurance Australia really met expectations, maybe upgraded their margins a little over the next 12 months, but we thinking that Insurance Australia Group has probably ended this downtrend. It's had a consolidation phase. We're now looking for it to break out and start to trade a little bit higher and shift to algorithm buy signals in the next 6 months. James Hardie, next pullback, we look for that to shift to buy signals. Medibank, likewise, we wait for that to pull back and shift to buy conditions. NAB, we're a bit cautious on. Newcrest, preference Northern Star over Newcrest. Origin, basing, and in the early, I'll just jump back and chat a bit further on Origin. There's still pressure in the retail electricity prices, but whether that's in the rear vision mirror and we start to see a slight improvement over the next 12 months, the dividends coming through from the natural gas development in Queensland is still attractive, but if you want to be patient here, you'd be waiting for this to really break up through $5, pull back, and a shift to algorithm buy signals, and we'll obviously draw your attention to that. If you're a subscriber, you're going to see these transitions from sell signals into buy conditions. What you're trying to do is capture the early stages of the trends developing in these large cap stocks and stick with them for a considerable amount of time. QBE, I think we'll see that shift to buy conditions later this year. Ramsey tracking sideways. Sonic Healthcare, we look for that to pull back. And the pattern there is probably as we start to see the testing levels fall away for COVID, we'll see a softer earnings outlook for Sonic, but the underlying business is extremely attractive and we'd look to buy that on any weakness in the back half of this year. Suncorp, look for that to pull back and a shift to buy conditions. Transurban really just tracking sideways there at the moment. Telstra, look for that to pull back and shift to buy signals. A little like Amcor, Telstra was one of the few stocks out of that's under sell conditions that we've been highlighting that you want to hang on to that, and we've been buyers of it because of the corporate action there with them spinning off TowerCo, but also the commentary out of the company. They flagged some time ago that earnings were likely to increase year over year over the next 2 to 3 years. We've seen that earnings came in at about 6.8, 6.7, 6.8 billion. They've upgraded that over the next 12 months to $7 billion, so 4% yield, with 3-4% earnings growth is attractive in this environment. And there we are, back to Endeavour. So just to finish tonight, let's look at a couple of ETFs. So just on the resource side, our preference at the moment is really to look at managing that position size in Fortescue, BHP, Rio, where we're well positioned there to take profit on BHP at the highs, and we're now building a position in Rio, so that's worked very well for us. So we've got plenty of cash there to reallocate in those iron ore stocks if we see a leg lower. So I'm just really emphasise, yes, they're a buy, but manage the position size. The ETF that I was wanting to show you that is under buy conditions is the OZR. So if you're looking for a basket trade across the resource sector, you can have a think about that as an alternative to the individual stocks, but our preference at the moment is the individual stocks. If you're looking for something as a long-term growth opportunity in the market, the Cure ETF, the correction that's had from 85 down to 59, and the IKO, which is the South Korea ETF. We hold this in our iShares model, so if you would just a touch on that, and I'll finish on this evening. So we have two ETF models. One is the ASX All ETFs, which, as it would suggest, it analyses all ETFs listed on the ASX and shows you which shares we hold. And then we have the ASX iShares ETF. So if we have a look at that, and we see here that the Small Ordinaries was recently added, and then the iShares South Korea has been added. The percentage performance of these ETFs have been extremely attractive, so if you want to follow that model, just a reminder, make sure you turn on the envelope, and just highlighting the difference between the iShares and the All ETF model. So the All ETF, you're going to see a much broader section, whereas the iShares is limited to the iShares only. Thank you for listening in this evening. On the earnings result coming out over the next few days, keep an eye on Ansell tomorrow, Centre Group, and I'll summarise some of these on the blog. So we've got Ansell tomorrow, Boral, Kogan, which will certainly be an interesting. Kogan's under buy conditions at the moment. APA Group on Wednesday, Medibank on Wednesday, and Bega on Friday. So we want to touch on this one and finish there. Bega's corrected from around $6.50 down to $5. The market's got pretty low expectations going in the results on Friday, so I'll be analysing that with great interest and updating you via the blog. Thank you for listening in. I look forward to speaking again next